In the present market regime, every Tuesdays and Thursdays, the clock ticks faster and the premiums evaporate like water. That's an expiry day. If you are not prepared, then the markets will collect more than just your premium. So let's fix that. I am Pranav VK, your strategy guide here at Stockshaala by Kotak Securities. In this video, we are going to understand the nature of weekly expiry, how the markets are generally on these days, and most importantly, we are going to evaluate the various strategies and see which one suits best for the ongoing markets. So let's start with the nature of the weekly expiry. Weekly expiries generally have cheaper premiums and having high theta decay rate. On expiry days, theta works very fast. A premium trading at Rs 100 can go to zero in no time. Theta is especially higher after the first half and in the second half. On the other hand, because of the other Greeks, it can also go from 0 to 100. Emotions are extremely high during these days, because of which emotional trading as well as revenge trading is a very common mistake. So what do you need on these kind of days? What you need is a plan and not speed. So here's what I'm going to do. I'm going to discuss some common strategies, safer alternatives, and some beginner-friendly strategies that you can execute on expiry days. So let's start with the first strategy, an at-the-money straddle. So let's assume that Nifty is at 25,000. So in this case, what you're going to do is you're going to sell at-the-money call option as well as put option. So in this case, we have 40 rupees and 45 rupees. So overall, you're getting a credit of rupees 85. The break-even points for this specific strategy is going to be 25,000 plus or minus the total credit, that is 85, which means on the either side, if the market goes above 85 points, then you're going to start making a loss. Now remember that when you have net credit strategies, it is very important to sell the strategy when the IV is high. And on expiry days, the IV is generally or extremely high in the mornings. But most importantly, you are going to go for this strategy when you see that the view is going to be neutral or range bound. So the factors that is in our favor in this strategy is number one, time decay. Number two, if the market is range bound, then you're going to make a profit within the range of 25,000 plus or minus 85. And most importantly, this strategy has an unlimited loss potential. So which means putting position sizing as well as proper stop losses is extremely important. If you feel there is a lot of uncertainty that is building up when you're inside the strategy, then it is very wise for you to exit the strategy and wait. Now, if you are a person who is risk averse and would like to have a defined risk as well as reward, then convert this ATM straddle into a butterfly like we discussed in the previous video. So what happens is your present payoff diagram for an ATM straddle looks something like this, where this portion is your profit and below this is your losses. Now by converting this into a butterfly, you're adding limited loss on either sides. And how can you do that? You can do that by buying a put option as well as call option out of the money. Now if straddles are not your thing, don't worry, because I'm going to teach you a safer alternative. So before we get to the safer alternative, let's do a quick recap of when you have to do a ATM straddle. It's best to do early in the mornings as soon as the market opens, because that is when the uncertainty is generally very high and IV would have spiked. So when the IV is already high and you've entered into a straddle and there's an IV crush because there is not much movement in the markets, that's when you as a net credit strategist is going to make more money. While straddles or iron butterflies are good for weekly expiries, Strangles are going to give you a broader or a wider range where you can work around with. And that's what makes it a safer alternative. So let's look at an example to understand better. So here we have Nifty at 24,000. And what I've done is I'm going to sell a 23,500 put option, which is out of the money, at rupees 30 premium. And I'm going to sell a 24,500 call option at 35 rupees premium, which is again out of the money. And the total credit that I'm going to get is rupees 65. So the payoff diagram, as we have discussed in the past, looks something like this. So this is going to be my lower strike, that is going to be 23,500, and this is going to be my higher strike, 24,500, and the market is right now at 24K. So if my market stays in this specific range of 1000 points, then I'm going to capture the entire 65 rupees premium as profit. But if it goes beyond a certain range, that is 24,000 plus or minus 65, then that is when I'm going to start making a loss on either sides. But if you are a risk-averse person where you would like to go for this strategy but would like to have a defined risk as well as reward, then convert this specific short strangle into an iron condor. How can you do that? Again, you can do this by adding two more legs by buying a call option as well as put option, which is further out of the money on either side. The best time to go for a short strangle is very similar to the best time for a short straddle as well, which means when the IV is high and early in the mornings when the uncertainty is higher and IV is going to have a crush over a period of time. But let's say, for example, the market started very flat and there was not much movement in the mornings. Then what you can expect is a lot of movement in the second half. Generally, when the European markets open up in the first half of the markets, then that is when the volatility also spikes up a bit. And you can take advantage of this spike and choose the right direction or strategy so that you can profit on the expiry day. Now you must be wondering, Pranav, you showed us so many strategies in the past which involved strategies like a long straddle or a long strangle as well. But when it comes to expiry days, you're only showing us the short straddle or the short strangle. Any specific reason for that? The reason is very simple. On expiry days, theta is extremely high, which means we can take advantage of time decay. And as net credit spreads, that is exactly what it does. And that's why I'm showing you short strangle as well as short straddle instead of the long forms. Now some of you would be wondering, Pranav, 4-legged option strategies are too much for us to do for the very first time. So here's what I'm going to do. I'm going to share some beginner-friendly strategies so that you can execute them and understand how to move forward. And eventually you can evolve to a much complicated or a more rewarding strategy. Before we head to these beginner-friendly strategies, I would like to highlight some important points. The first important point is that whenever you enter into any of these strategies, don't wait until the end of expiry to book profits. With my years of experience in the market, what I've realized is that, for example, if you have entered into a short straddle in the morning at around 9:15 AM and by 10:30, if you see that majority of the profits you have got it, or even 0.5% or 0.6% of profit is already there, then go ahead and book the profit rather than waiting the entire day for the remaining 0.2 to 0.3%. The second important point is that don't sit and trade the entire day. Rather, set a time where you're going to trade beforehand and enter and exit within that time, irrespective of whether it was a profit or a loss. This will help you create a healthy lifestyle with trading. Otherwise, it's going to start affecting your other daily habits, and that is not going to be good for you nor your family. And finally, and the most important, don't randomly trade on the day of expiry when the hysteria is high. Rather, if you have a plan, then go ahead and execute it with caution. So coming back to our beginner-friendly spreads, there are two of them. One is the bull put spread and the other one is a bear call spread. Now in this video, I'm not going to go completely in depth of these strategies because we have already covered this in depth in the previous videos. So go ahead and watch them in depth. But in today's video, I'm going to talk about this in terms of the weekly expiry so that you can execute efficiently. So starting with the bull put spread, the payoff diagram looks something like this. So you would have sold out of the money put option and you would have bought a farther out of the money put option. And this creates a payoff diagram like this, where you're profitable beyond a certain point and you're loss making beyond a certain point. So let's say Nifty is at 15,000 and you want to enter into a bull put spread. The best option that you can go for is actually going for a bull put spread which has very high probability. Especially if you're doing this for the very first time, then I would recommend something which is farther away. So you're going to sell an out of the money PE which is probably trading at 14,500 and you're going to buy OTM PE of maybe 14,000. Let's say this is trading at a premium of 10 rupees and this is trading at a premium of 1 or 2 rupees. Since you're selling the 14,500, you're going to get this 10 rupees as credit. And since you're buying this, this is the premium that you're paying. So this is going to be debit. So your total credit for this strategy is 10 minus 2, that is rupees 8, which is also going to be your maximum profit. Nifty in general doesn't move too much, right? So since you're taking 500 points away, if the market stays above 14,500, then you're going to make the complete 8 rupees in profit. And hence, I request you to go ahead and do a further out of the money PE sell and a much further OTM PE buy, so that your probability of profit is extremely high and you will not be disappointed. Similarly, on the other hand, if your view is bearish, then that is when we are going to go for a bear call spread. The payoff diagram of a bear call spread looks something like this. Now let's assume Nifty is at same 15,000 and I expect it is going to be below 15,000. But to stay on a safer bet, what you can do is you can go for selling a 15,500 call option and you can buy a 16,000 call option. Now let's assume that this is trading at somewhere around, let's say 7 rupees and this is trading at, let's say again 2 rupees. So again, since this is a net credit spread, you're going to make 7 minus 2 rupees, that is going to be rupees 5. Now you must be saying that, Pranav, just to gain rupees 5 per lot in profit, should I really do all of this? The thing is, in trading, consistency is more important than making higher profits in a single trade. So this is going to allow you to get consistent results because the probability of profit is going to be very, very high. Now, how often do you see Nifty going more than 500, 600 points? Not really, right? So that's why this is going to have a high probability of profit for you. Both these strategies are very, very boring and not exciting. And that is exactly why you should do it. Boring stuff actually makes money. So simple things make money and simple things are not exciting. So go ahead and prepare your mind because trading is not for excitement. Trading is to make money. Option spreads are like seat belts. You may not feel the speed, but you will survive the crash. Here are the things, if you don't follow, that can make your trades go terribly wrong. Not just wrong, terribly wrong. Selling naked options without stop losses. This can make you lose your entire money and more. The second biggest mistake is over adjusting the positions every 5 minutes. The moment the P&L goes from green to red, people start readjusting the entire strategy, and that is not the right approach. Net credit spreads often require more time because they make money because of time decay. But if you don't give them enough time, then you'll always keep readjusting and keep losing money. The third biggest mistake is buying out of the money options, especially in the last 30 minutes and expecting a jackpot. Many traders call them zero or hero trades, and I would never recommend that because it's going to wire your brain in a specific manner, which is going to make you do that even on other days. And finally, the biggest mistake of all, averaging your positions once you're in losses, or increasing your position sizing after you're in losses just in the hope of recovery. That is a pure recipe for disaster. Remember that most expiry day blow-ups happen because of no plan plus emotions. But here at Stockshaala by Kotak Securities, we have given you all the tools from scratch so that you can create a clear plan for yourself before you make your next trade. So let's quickly summarize what we have learned so far. So we understood that it is better to go for net credit spreads or net credit strategies during weekly expiries because Theta Decay is highest on these days. We started with the at the money straddle, and I also recommended that you could convert it into an iron butterfly in case you would like to have a defined risk and reward. Second, we discussed a strangle, and I also recommended that you could convert into an iron condor so that again you can have limited downsides. And finally, we also looked at the beginner friendly strategies, that is the bull put spread as well as the bear call spread, which you can execute with ease. And last but not the least, we discussed the biggest mistakes that traders must avoid so that they can retain in the game for the longest amount of time. In the upcoming video, we're going to discuss something very interesting, that is put call ratio or PCR, and why it's one of the most powerful tools for options traders. You're watching Stockshaala by Kotak Securities. Make sure to like, share and subscribe. I am Pranav VK and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.